The inevitable is starting to happen with the ravages of inflation. Americans are now starting to dip into their pandemic savings in order to cope with inflation. And so that leads to confirmation of the theory that we could potentially be walking into a consumer-led recession. And that's what we're going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this one's a very important topic because from the perspective of portfolio construction, we all have to focus on downside risk, which is something that I've been talking about on this channel for a long time, because we all saw this, at least in the value investing community, we saw this a year ago where we did believe that the consumer was expected to slow down with either higher inflation. So the sort of like the reacting to the higher inflation and inflation for products being higher than the rate at which wages were increasing. And so we had it sort of like a negative real wage growth and the potential issues of rising interest rates. And so what we're seeing now is that they actually have started increasing interest rates, and quite aggressively, might I say. And so it's really tapping the consumer because inflation is still going up, at least albeit slightly, but everything is now costing more, including sort of like new mortgages and any sort of like floating debt is now costing consumers more as well. And so people are getting pinched on both sides. And what is this actually going to end up with? I personally believe that we're headed into a consumer-led recession if we're not already there. And so the Wall Street Journal reported recently that Americans have started tapping their pandemic savings to cope with inflation. Households at almost all income levels has started to draw down accumulations in the first quarter to cover costs. And this is sort of a chart that was in the article, and you're seeing that personal savings rates have come under the pre-pandemic rate. And obviously one of the reasons why you saw that savings rates jump so much is that a lot of people were able to sort of freeze their sort of mortgage payments for a few months, and all of that excess cash just sort of went into their accounts. Well, now we're running into a situation where, people are now back paying their mortgages and their rent, but in addition to that, all the products that they're purchasing are much more expensive. The other thing that doesn't really get talked about in these articles is that tax rates effectively are sort of hedged to inflation. And so when you're out there buying products that are higher priced products, well, the goods and services tax, or sort of like the sales taxes, are automatically geared to that higher price. So not only are you paying more for the product, but you're also paying more for the sales taxes on top of that product. And in an environment where you have negative real wage growth, you're just spending a higher proportion of your overall earnings on tax, in addition to the tax that you're paying on the products as well, i.e. the inflation rate. And so you're just going to start getting tapped out, and that's why we're seeing these saving rates start to decline. Now, the article continues where they say that from the start of the pandemic to the end of 2021, households built up $2.7 trillion in excess savings. So way to go, Americans, for building up that excess savings. But however, now with inflation at its highest point in decades, and what I said is that wage gains have actually trailed behind the rate of inflation, Americans are turning to their excess cash to cover costs. And nobody's sort of safe from this, because you can see that the percentage change in the median checking bank accounts from 2019 has declined across all income brackets. So the bottom 25 are as impacted as the top 25. So nobody's safe in this environment. Obviously, the people on the bottom would get impacted more by inflation because they just have less to draw on from the perspective of just excess savings in general. But you can see that everybody is sort of being impacted with higher prices. And it looks like Jamie Diamon is saying that there's quite a bit of pain potentially on the horizon, because he believes that US consumers have around 6 to 9 months of spending power. However, he is warning that an economic hurricane looms despite the pandemic stimulus. Now, diving deeper into the excess savings by income level, this was a great chart put out by Moody's. What Moody's found is that the bottom 20% of earners were the only group that didn't draw on their pandemic savings in the first quarter of the year. Yeah, you heard that right. The bottom 20% of earners did not draw on their pandemic savings in the first quarter of the year. And part of the explanation is that these people are working in leisure, hospitality, retail, and healthcare, and all of these industries have strong wage growth, which has allowed many of these workers to continue to save. The only thing that I would add on top of that is that the bottom 20% generally don't have that much savings to draw on anyways. And so they just have to work more. And so that might also be adding to that calculation of them not drawing on their savings. Look, if your wages are going up or if you have access to work, why draw down any of that little bit of a nest egg that you have? I think the thinking is clear across this socioeconomic group, at least right now, whereas work while the working is good and just have a little bit of a nest egg set aside. But look, if we enter into a consumer-led slowdown, the first area that's going to get hit is the retail, the hospitality, the leisure industries. And so these people are very susceptible to having to draw on and even go into negative. So like credit lines and stuff if the economy turns negative, which is sort of what we're expecting. And it's sort of what the Fed has been mentioning in their recent transcripts as well, where they could see an economic recession as a result of the tightening. But from an investor perspective, or at least a value investor perspective, what does this mean for us? Well, I do believe that there are situations where the baby is being thrown out with the bathwater as it relates to stocks. And here's what I'm talking about. This is the tracker that the Patreons get access to. And in the tracker, you can see that there's 10 names now that are trading under 50% of their intrinsic value. And there's 20 names trading between 50 and 75% of their intrinsic value. So I unlocked some for you to see. So you can see Alibaba, of course, if you've been watching this channel at all, is really cheap, despite the fact that it ran up to around $120 per share from $80 per share, so a 50% run up. They're still trading at what I think is approximately 40% of their intrinsic value. Best Buy, which is a name that I'd like to add very soon, is trading at approximately 50% of their intrinsic value. Zillow, this is a name that I own in the portfolio, is trading at approximately 55% of its intrinsic value. Alphabet, this is a name that I'm looking to add after they split. They're trading at approximately 56% of their intrinsic value. HP, this is a name that Warren Buffett recently bought. They're trading at approximately 60% of their intrinsic value. Meta, I don't need to say another word about Meta. You've seen me cover it on this channel quite a bit. Dave & Buster's, a favorite of mine. I want to buy this at anything under $25 per share. And Canada Goose, because I'm Canadian, you got to own this name, but I want to own it at under $12 per share. Now, every single name on this tracker, the ones you can see and the ones you can't see, have a full detailed model supporting that valuation. And how do you get access to those full detailed models? Well, you can get access to all of those at the lower tier of the Patreons. Everything. And if you want to join us for a live epic presentation where I share my very best research, which is reserved for that call, you can join that at the higher tier of the Patreons. And like I always say, there's no risk to you, because if you decide that it's not for you, within the first month, message me, let me know, and I'll fully refund your first month's subscription, because that's how much I believe in the product. Now, when it comes to consumer-led recessions, Michael Burry has actually predicted this from the perspective of a bullwhip effect. And I actually covered this in a previous video, so in order for you to access that video, click right here.